In a market which is still pretty tough, but albeit that it's improving, we're seeing certainly an overall improvement in the market. We're pretty pleased with 8.1. I think we did say to investors at the year end when we released our June results that we had grown our distributions then at 5.8%. That we thought that was the low point and that we would be looking to start growing at an increased rate from there. So we're very pleased with 8.1%. If you look at the fundamentals, our vacancies have come down from the 6.4% level to a current level of about 5.5%. Within the three sectors, retailers in all three sectors have actually improved in terms of overall vacancies. Yeah. Property expense ratio, we managed to contain that. That hasn't gone up by much at all. So we again are pleased with that result. But all in all, in a market that is still quite tough, I think the other key metric for us is obviously our arrears and our debtors. And again, we've managed to contain our arrears to very, very low levels, and the bad debt write-offs, in fact, for the period were quite minimal.
Yeah, talk us through the occupancy levels, because as you say, the market remains extremely tough. All the other indicators we've seen in the economy are suggesting that we're seeing a gradual improvement in the overall state of the economy. From what you're seeing from the property side, what are you seeing? Are you seeing the same kind of picture?
Very much so, yeah. I mean, we certainly did predict that our vacancy, which at year-end in June last year peaked at 6.4%, would have been the peak. And from there, we would seek to improve on that vacancy ratio and bring it down. And that has materialized. So in the retail, I think our vacancy is sitting at the moment about 2.4%, which is very, very low. And then again, one needs to understand the mix there between your high quality regional, your large regional centers versus your smaller type centers. Yeah. In the big shopping centers, it's below 1%. In offices, we've improved it from about 9% to just over 8%. That's the tough space at the moment. The office space is still the tough space at the moment, and we're finding it difficult to retain tenants. More often than not, we're finding that tenants, when their lease expires, it's a struggle to keep them. They've got options, because nationally the vacancy rate is probably is even higher than that 8%. Yeah. And then in our industrial portfolio, again, I think we did particularly well, bringing it down to 5.5% from 6.4% or 6.5%. Industrial sort of in between. It's not as good as retail, it's not as bad as office. On balance, though, all of them are improving, but it's a gradual improvement in line, I guess, with the economy. I think GDP numbers came out yesterday slightly better than expected, and we hope for that to continue.
No, but take us through the numbers then, because the overall picture you paint is that of an improvement, but you do note that there is still a very tough market in industry, and you also notice that there's a tough market on the office space. Why are there difficulties in those areas, do you think?
When your vacancy rate is as high as 8%, and as I say, Growthpoint's portfolio of offices is a very good quality portfolio, and our vacancy is much lower than many of our competitors. So when a tenant's lease comes up for renewal, and he can choose from 20, there are possibly 20 buildings that he could go and sign a new lease with. Yeah. All the landlords are fighting for the tenant. They're prepared to discount the rent. They're prepared to offer a rent-free period. They're prepared to offer, we call them tenant installation allowances, etc. Which call them incentives for the guys to come to their building. So it's very competitive out there, and we're finding obviously that is what's having a negative impact, if you want, on the office numbers at the moment. It's less evident in retail, and it's also less evident in industrial. Yeah. But notwithstanding all of those pressures, I think we've been particularly successful in not only keeping our tenants. I think our retention ratio on leases that have renewed been in the order of 67 odd %. Which is pretty high. Certainly can be better, but it's pretty high. And then we're still experiencing, on average, positive reversion. So when a guy's lease expires, let's say he expires at 100 Rand a square meter, we're still managing to get higher rental on the renewal, right. Which again for us is positive.
Norbert, we saw you recently teaming up with a group of local investors to get back the waterfront from the investors from the Middle East. What are you expecting out of that property? Is there more that can come out of it?
Certainly we hope so, otherwise we wouldn't have been interested in partnering with the PIC and the government employees pension fund. You know, they are partners in this. And, you know, it is arguably, you know, one of the greatest real estate assets in South Africa, possibly even on the African continent. So, you know, we long-term property investors, and you know, clearly that type of asset, you need to take a long-term view. You can't take a 1 or 2 year view on that. So we think that there certainly is more value to be extracted there, not only in terms of the existing assets that are there and income producing, but also the potential that can still be untapped in terms of the future development rights that exist. Yeah. As part of our purchase, we purchased 220,000 square meters of bulk development rights, and that allows us to develop, you know, that to that extent. And that is the real excitement in terms of the future. You know, yeah. That is where we think the real value potentially could be unlocked.
Sure. Does the tough market in South Africa now provide opportunities for guys like you, as big as you are, to consolidate and perhaps take up some of the smaller guys who are struggling in this market? Yeah,
I think certainly sector consolidation will continue. There's no doubt in my mind. We're always looking. We're looking at everything. There's very little that we don't look at. So no, absolutely. And so yeah, I think, you know, with a big balance sheet, I guess, such as what we have at the moment, you know, access to funding is still, you know, reasonably good. There's quite a bit of liquidity that is still in the debt markets, capital markets in general. So I think that you know, there definitely will be you know, a further consolidation in the sector.
Yeah, you were represented in South Africa. You have looked at Australia, but you have not really looked at the rest of the continent. And yet, if you talk to the global research houses, everybody is beginning to talk about Africa as a potential investment destination that's going to rival your Indias and your Chinas. Have you considered the rest of the continent?
We have, albeit, you know, on a very superficial sort of level, if you want. I think our biggest challenge, and probably the biggest issue that we face as a long-term property investor, is we're not always very comfortable with the, let's call it the legal system, the system around protection of property rights in many of the countries north of our borders. We have some investments in Namibia, and that's probably the only investment that we have outside of South Africa. So, you know, I think the food retailers, yes, they're rushing into Africa. Yes, they're building. Not from a property investment perspective. They're building properties, but my understanding of the reason for them building these properties is it is to create an outlet for their product. It's not a pure property investment decision. They have to have an outlet for their product, so they have to have property and they have to have buildings. Yeah. And that's what's driving them to build there. Yeah. Our game is different. We're long-term property investors. We rely on long-term capital growth, yeah, growing rentals, demand for space, and we don't really see those dynamics to the extent that we would require them to be prevalent in many of those African markets.